Good evening, and thank you for joining this call with DSP on interest in gold as an investment option. We have seen the way this asset class has behaved during the COVID period. The recent movement on the never seen before inflation number by the developed markets, especially the US, a three-decade high on the inflation, the negative real rates has brought a lot of interest back into this asset class. The prices of the asset class is reflective of some of these macro changes that are there. A lot of noise around taper, fiscal stimulus reducing, inflation remaining high, not being transitory, so on and so forth. All of this, which is indicative of a reasonable allocation and an interest in the asset class. To know more about, and DSP particularly has been a strong proponent of gold as an investment option, but slightly different from the traditional options that one has through sovereign gold bonds, gold ETFs, etc. We have a World Gold Fund, which has a fairly long track record, which invests primarily in gold mining companies who seem to benefit immensely when gold as an underlying commodity does well. To know more about it, to understand the nuances, what to look forward, we have with us Sahil Kapoor, who comes with an extensive experience over 1.5 decades across market cycles, across commodities. Sahil has been a trader himself, has strategized various strategies on commodities, fixed income, and equities in his earlier stints by dealing with large family offices and HNI clients. Sahil also has a keen interest in global markets, is quite proficient in understanding the nuances of the commodity cycle and linking all of them together. Without taking much time, I hand over to Sahil to take us through this quick but insightful presentation.
Thank you, Usha. Thanks for the nice intro. So today I'll take you through gold as an asset class and also talk about how to play it. There are various ways of playing gold, and I'll take you through all of them. I'll put on my presentation. And we'll speak about certain important aspects which are important for the gold as an asset class and for the market. So let's start off with the DSP World Gold Fund. The fund invests in BlackRock Global Funds World Gold Fund, which eventually invests in companies which are gold mining companies. These companies mine gold and generally are many of them are fully integrated. They are not into exploration a lot, largely senior and junior mining companies, which I'll explain what they mean going forward. So let's start with the outlook on gold. If you see what has happened recently, that there has been huge rally in equity markets globally, barring today. I think today was a day of correction across markets globally and domestically. There has been a heightened geopolitical risk, more so in terms of how certain relationships are panning out in energy markets, specifically across Middle East, Europe. There are a lot of repercussions, even long-term repercussions of those changes. Thirdly, there is a huge volatility in underlying economic growth. You would have seen, all of us have used this word unprecedented. We've never seen anything like this, dip and then a recovery. You can see that global growth dipped significantly and then it recovered. Just to give you a sense of how this, recovery has been. So, before COVID hit us, global GDP was at about $87 trillion. It dipped to about 84 trillion. And it is now heading back above 87 trillion as we speak, all in about 20 months or so. For global GDP to move by about 2 trillion or so, it takes about 1 full year, or sometimes it takes about 1.5 years. And we've seen global GDP moving more than 10% roughly up and down in 20 months, which we've never seen. So this is the kind of movement that we've seen over a long period of time, and now this volatility was introduced. And the other part is that gold's track record as a diversifier is extremely important and exemplary. I'll show you some data which is extremely interesting, which will come ahead. But gold is an asset class which is uncorrelated to US large cap, very, very mildly correlated to emerging market stocks and EAFE stocks, very, very mildly. And you could say that the correlation is insignificant. It's insignificantly correlated to bonds, inversely correlated to the dollar, which is again a very, very strong correlation for many, many years. There is no correlation with hedge fund returns or private equity returns globally with gold. And also it doesn't have any significant correlation with alternate asset classes like REITs or InvITs. So this is one of a kind asset class which generally provides you an uncorrelated exposure. And for many, many years, many centuries, it has been a disaster insurance. So I'll cover these aspects on how this plays out. But one of the most important themes right now that we've seen, which is extremely important, is how globally there has been a huge debt increase over the last 20 months or so. Beginning March 2020, and even a few months before that, the global central bank started pumping huge amount of liquidity to avert any crisis from the pandemic. And the debt levels have gone up significantly. If you see the G4 balance sheet, the large G4 countries, including United States, their balance sheet has gone up by 66% in last 18 months. And you would have seen many statistics saying that more than half of all dollar printed, all the dollars that have ever been printed, more than half of them were printed in the last 18 months or so. And this number is true not only for dollars, but for many other currencies. So it's been the case everywhere. Huge, what I call financial debasement has taken place. All the countries have printed a lot of money. And what they did with that money is they provided fiscal stimulus. Central banks provided that money to their governments, and they utilized that money to give it to people. For example, in US, they offered checks, 3 stimulus checks to their whole population. Japan did the same. Eurozone did something similar, but in more pockets than openly. Many other countries took the way of, cutting taxes. The other took the route of giving strong, debt push, the credit push into the economy. So, by guaranteeing credit. So that's been the case across the world. And what it has done is it has created a huge amount of currency debasement. And the net result of that currency debasement is that the overall monetary base has gone up significantly. So if you look at this chart shows you the total monetary base in US. That means the total money which is printed. And if you look at this light colored blue line, the dark colored blue line is the overall monetary base. Generally, we've seen historically gold tracks 40% of this monetary base. When it is doing well, when it is an open market, unlike this period where it was a fixed price, and even prior to that, we've seen generally that gold tracks this number on a long-term basis. In 2022, this number is expected to hit about 6,382 USD in terms of the overall size of US monetary base. Which gives you at 40% monetary base, gives you a gold price of about 2,500. And that's the most likely target for gold in 22 based on this historical data. And gold has tracked this quite well over a period of time, but there are no sureties here. I mean, you can't really say by with 100% confidence that when and which month gold will go and touch this number. But the underlying fact is that the huge amount of currency debasement gives you a good indication that gold is likely to head higher. Second important point, a lot of people raise this question that every asset class has gone up in last 20 months or 2 years except gold. Gold did move last year. It went up 50% when markets are not doing well. And once stocks and bonds and other asset classes started to do well, gold did nothing. All of 2021, gold is still flat to down. I think about 3-4% down for the year in 2021. But if you look at this matrix on the left side, this table, this has got 2 columns. One is the capital markets, the returns that stocks and bonds and other alternate gives in totality, and there is gold returns. So whenever there are strong returns from capital markets, gold usually doesn't perform well, right? And when capital markets start doing badly, or their return starts to fall, gold starts performing very, very well. And that's been the historical correlation. Largely, I told you earlier that gold doesn't have a very strong correlation with any asset class. It moves on its own. Historically, what we've seen in that when broader markets don't do well, generally gold tends to perform very well. And the basic premise behind that is the incremental investment demand for gold. Hold that thought, I'll come to that. But that is the most important driver of gold prices going ahead. And if you look at globally, at this time, we have one of the highest negative yielding debt. Last few months, we've seen, the interest rates have gone up at the short end. 1 year, 2 year bond deals globally have gone up. To some extent, even in India, they have gone up. In US, for example, US 2-year bond has gone up from 15 basis points to about 60 basis points. Although the 10-year yield has not moved. So the overall negative yielding debt is very, very high, right? So if you look at 2-3 parameters, which I'll showcase ahead also, mostly equity markets globally, most of the equity markets are trading at P multiples of 20 plus, which is unprecedented. Haven't seen these kind of valuations in a very long time. Largely, it is a function of very low interest rates, right? Apart from the good, strong earning growth that we've seen. And there are various factors why we've seen that kind of earnings growth. Not going into that, but equity as an asset class is seeing record valuations. When you come to the bond market, yields are so low that real rates are negative, which I'll showcase up next. So that means even bonds are trading at maybe 100 P or whatever number you want to pinpoint. For example, US at 1.5% yield, you can just take any guesstimate where the PE would be, right? So they are trading at extremely high valuations, so to speak, even the bond market. And even commodities other than gold has seen a very, very strong rally. For example, oil is trading above its marginal cost of production for, I think, about 8 weeks running, which is very rare. And most other commodities, whether it is copper, zinc, nickel, all of them have rallied strongly, right? So that tells you that there are not many asset classes which can give you let's say a value buy proposition where it makes sense to continue to add that asset class. And in those times, generally gold will perform well when these asset class begins to see lower performance. For example, a case in point is today, where you see that globally most markets haven't done well today and they've seen sharp cuts. But gold, more or less, in the last 2-3 months is very stable. Although it's volatile between 1750 and 1900, but net it hasn't really gone down so much, versus the other asset class, which has seen some cooling off. So generally, we'll see this pattern unfold over a period of time, that when other asset classes become volatile, gold will begin to move after they start to cool off. Another similar point which I made earlier, that whenever you see that equity markets, for example, I've used S&P 500 here, they give a negative calendar year. In those years, generally gold performs very well. And there are a few exceptions like 1981, 94 or 2015, but generally gold outperforms on an average 1:1. And we've seen, for instance, I'll tell you that in last 14 years, Nasdaq has given only 2 negative years, and those are -2 and -4%. One of the strongest rallies globally. Similarly, Dow Jones has given, I think, about 11 out of last 14 years are positive. Very, very strong, uptick. And many other markets are very similarly placed. So when you combine your opinion that, let's say, equity markets are trading at premium valuations, bond markets don't offer any strong yields, which I'll show next, it makes a case that gold becomes a very good, strong diversifier at this point. So if you look at gold prices, they track negative rates very, very closely. If you look at these two lines, the red line is the gold price itself, and the yellow line is US 10-year real interest rates. What are real interest rates? When you remove inflation from what you get as an interest rate on a bond. For example, if you buy a 100 rupee bond and it offers 5% interest, that means you get 5 rupees on that bond every year. But if inflation is 6%, you lose 1% in your purchasing power, right? So that -1%, which is 5% minus 6%, that -1% is the real interest rate. That means in reality you are losing money. So when real interest rates become the norm, or real interest rates become negative, gold generally benefits. And it's generally called financial repression. That means if you invest in financial assets, you end up losing money in real terms, adjusted for inflation. So if you look at this yellow line, when this yellow line is going up, that means real interest rates are becoming more and more negative. This is the inverted axis. So yellow line going up means real rates are becoming more and more negative. This can happen because of two reasons. One, that interest rates are cut rapidly. Central banks cut interest rates, or bond yields fall rapidly. Or it can happen when inflation goes up significantly. So in last 6 months to 1 year, both the things have happened together, right? In last 20 months, central banks have cut rates to zero, most central banks in developed markets. And even in emerging markets, they have cut it down to all-time lows. And inflation is either up in most countries, or it is very, very stable. For example, in India, inflation is between 5 to 6% over a very long period of time now, last 20 months, 24 months. We haven't seen spikes like US or other countries, but it is still at the upper end, right? And rates are at nearly at all-time low. So whenever this ratio, if you see these charts together, they will generally move in the same direction. And when you look at the real rates right now, look at this US real junk bond yields. That means junk bonds are the ones where the probability of default is the highest. So they generally command the highest yield. So they provide the highest yield in the market because their default rates are very high. So for example, think about buying a rated bond, or a minus rated bond in India, which will give you a yield of whatever 10 plus or 11-12%, because the probability of default is highest. In US, those bonds are also yielding negative returns, right? So that means if you buy those bonds and hold them for a year, their coupon will not even cover inflation. That is the kind of fall in interest rate that we've seen. The sovereign yields are already negative, minus 4.7. This is adjusted for CPI. You can do a lot of other variations where yields will look minus 1%, basis forward-looking inflation. But the key point is that most countries or most currencies offer negative yielding debt today. Okay, even in case of India, I think the rates are close to zero or slightly negative and adjusted for inflation. The other component which is extremely important for gold is the US dollar, right? So I'll give you a brief roundup of what we've covered until now. First is that we spoke about that gold as an asset class has a merit in diversifying your portfolio, because it is generally uncorrelated with other asset classes, and it tends to perform well when other asset classes are not doing well. Second important point is that there is a financial repression globally. Huge amount of money printing has happened, which usually favors gold because gold is sort of a quasi currency. Third important point is that over the last 20 months, there has been a huge increase in negative yielding debt. Interest rates globally have become extremely negative, and usually, historically, gold moves nicely with negative interest rates. So if rates are becoming negative, gold begins to go up. And the other very, very important factor, or probably the elephant in the room, is the US dollar. US dollar generally is negatively correlated. This is the only asset class which has a statistically significant negative correlation with gold. That means if dollar is going up, generally gold, either it will not go up or usually it will go down, right? So for the last 3 weeks, you've seen dollar index per se move from 93 to near 97 levels. A good 4.5% move on the dollar. And in similar times, you have seen gold has become very volatile. It tried to break out, but it couldn't. So this is just a case in point. And similarly, if you look at, let's say, this 2001 peak in the dollar index, right? So gold started moving up in about 2000, 2001. And for 11-12 years, until about 2011, gold became 10 times in price. It went from $200 to near $2,000. So when the dollar was very, very weak. And over the last few years, since 2011, the dollar became strong until 2017, where it reached a peak. And this is similarly reflected in what gold did, right? Gold still hasn't reclaimed its all-time high because the dollar was too strong in between. And even in recent times, you've seen, dollar has been a outlier. This year it was a consensus short, but did not go down at all. It actually went up, which we've highlighted throughout the year that dollar has the potential to go up. And now the dollar rally has stretched out to almost 4-5% YTD. Now it's placed at a very, very crucial juncture, right? Even if, let's say, dollar cools off a bit, and where equity markets are right now, which I told you at premium valuations, where bond markets are right now, again at premium valuations, the sensitivity of dollar to gold is very, very high. So if dollar were to crack even a little bit, basis of many reasons which I can give you, there is a good potential that gold prices will go up. And historically, we've seen periods where dollar and gold even move together on the upside, which I'll show you later. Now, when you look at the fundamentals, these were market-driven factors. There are also fundamental factors. When I began the presentation, I said that gold prices are driven by incremental investment demand for gold. I will tell you what that is, right? So if you look at gold mine production, it was going up for good about 7-8 years when gold prices are doing well. Gold prices peaked in 2011, and then the gold production peaked in about 2018. For last almost 3 years, it has been declining. This is just the half year production, but even in 2021, the gold production number will be lower than 2020, which was lower than 19, which was lower than 18. So for fourth straight year, gold mine production is on the decline. And if you look at year-end gold reserves from gold producers, they are also on the decline. So on the supply side, there is a lot of tightness. There is generally about 4,000 tons of gold, including new supply and old scrap, which is available in the market every year. And the investment demand is the one which moves gold. So if you look at where the investment demand comes from, it comes from 2-3 major sources. One is the gold ETFs globally, the overall gold ETF holding. If you look at this chart, it is in million tons, right? 110 million tons was the peak. It has been on the decline in 2021, which has caused gold prices also not to move up significantly. So gold ETFs is one source. Haven't done well in 2021. They did quite well in 2020. Jewelry demand was hit significantly because of COVID, because globally income levels were down. Biggest driver of gold demand is India, and the traditional demand from weddings and other traditional demand drivers, all of them were absent, or let's say most of them were absent. And now those demand numbers have started to improve. So if you just scroll or open your phone and check Google search results for imports for gold from India, you will see that they have hit record levels. We've been importing hundreds tons of gold every few months, and largely driven by huge upcoming demand in the festive season. You would have also read 8,000, 9,000, 10,000 weddings happening in Delhi. So all those numbers will revive demand for gold jewelry, which is again a very, 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 very strong number. If you look at this number, it's closer to 2,500, 2,700 at the peak, 2,700 tons. And in the last slide, I told you there is a gold mine supply every year close to about 3,800 to 4,000 tons. So about 60 or 2/3 to 3/4 demand comes from gold ETFs and jewelry, which is purely investment demand. And when you look at central banks, which are again an extremely important driver of gold, every year they consume between 500 to 600 tons of gold in new incremental demand. And last 2 years they haven't done that. Largely they were busy in seeing through their economies, because there were lots to do, and most of the central banks were helping their governments. So what they did, they increased their bond holdings rather than increasing their gold holdings. So when you look at the asset side of all balance sheets for central banks, their asset sides has doubled almost for all central banks. Even RBI's balance sheet has gone up by 30% plus. And most central banks have seen that increase by buying their own government's bond. right? So for example, US Fed is buying bonds for US Treasury or the US government. RBI has been active in the secondary market, doing huge amount of OMOs and helping with interbank liquidity, which in turns help the government to borrow. So they've been actively buying their own government's paper, trying to debase their currencies at the cost of not buying incremental gold. Last 6 months that has changed. If you see H1 2021 already breached the 2020 high, and this demand is set to go higher. So if you look at the 3 triggers for investment demand, gold ETFs, gold jewelry, central bank demand, all of them has already revived. So it is on a path to, let's say, the pre-COVID normal and maybe even higher. So now what incremental demand means, which I said that incremental investment demand is something which drives gold prices. So I think that gold is at the beginning of a structural upcycle. There is a massive currency debasement. As I said, real rates are negative. Dollar is soft, and probably it will be under pressure. Once the recent strength wanes, and there are reasons for that to happen. One of the reasons is that this new strain which is being talked about today, or let's say the weakness in growth across countries, that could probably propel some central banks like the Fed to go a little soft, right? They might still remove their quantitative easing, but their rate cycle may begin maybe not next year, maybe year after that. So that could probably put USD again on a softer path. Demand supply is extremely favorable. And as I said, gold is anti-fragile. It works well when other assets are not doing. So where will the investment demand come from? Incremental investment demand. So if you see gold ETFs are reviving, central banks are again buying gold. Gold jewelry demand is again back. But what will add that extra delta? So when, let's say, stocks are not doing well, there will be a demand for asset which is doing well. And probably once gold gets that momentum, that incremental demand will come towards gold. And it's very, very natural, and historically the data shows you that, which I earlier showed you, that happens on its own. When other asset classes stop doing well, gold begins to get that incremental investment demand. And the delta is very, very high because supply is extremely limited, right? So eventually all the 4 pillars, central banks, jewelry, ETFs, and now people who are coming for cross assets, for alternates, they all fight for the same amount of gold which is available every year. And that's why prices zoom up very, very fast, like they did 50% last year. So the gold price moves in bunches. There are 3-4 years of stellar gains, then a few years of sideways move. And when you look at a 50-year cycle, there are like a decade of super boom, and then maybe 1 or 2 decades of nothing happening. And that's the reason why how this incremental demand theory plays out. Now, what are the ways to play gold? So if we establish that gold is at the beginning of a structure up cycle, and we assume that gold prices could go to 2,500, how do you play it, right? One of the ways to do it is to buy gold ETFs, right? But one problem with buying gold ETFs is that if you already have jewelry exposure, which I'll give you an example, the amount of food that you eat in a year and how much that costs. So you could calculate it with a paper and pen, back of the envelope calculation. That is nearly the amount of gold that you buy every year. That's the general calculation for Indian households. And most Indian households are overexposed to gold as an underlying asset class. But what they lack is exposure to gold mining equities, right? Because when gold does well, of course, your gold jewelry and other consumable items, which are not investment items, they will also do well, but eventually you're not going to sell your gold jewelry, right? So the exposure to gold will come through by playing a derivative of gold, which is gold mining companies. So why is that? But for example, when you like steel, you go and buy steel companies, right? And when you like cement, you go and buy cement companies. You don't buy a bag of cement, right? You don't buy a HRC coil for steel and keep it at home, right? Because equities offer financial leverage, they offer operating leverage, and both of them give you outsized returns when the story becomes structural. So it's very, very similar for gold equities. Gold equities have a beta of more than 1.5, nearly 1.75 over gold. So for example, if gold prices go up $100, gold equity companies, if the index were to be made, it will go up by $175. So that's the kind of beta that gold enjoys. In bull markets, that beta is even higher, and in bear markets, that beta probably could decline also. But generally, on an average, that's the beta. So, for example, if gold goes up $1,000, gold mining companies will do extremely well. They will go up by 1750. But if gold falls by $1,000, they will fall even more. So that's why they are a little more riskier than the underlying commodity, which is very similar to any other cyclical sector, whether it is steel, whether it is copper, whether it is aluminium, which are the companies that you see in the equity indices. Very, very similar. So that is how gold mining equities are. But one fundamental difference between gold mining companies and other companies is that after a while, I'll show you in numbers, all the increase in gold prices starts flowing down to bottom line completely, because their costs are completely stable after a point. And I will show you where that point is. So options for investing in gold, as I have already explained this, physical ETFs or gold equities. So gold equities or the BGF World Gold Fund, which is the underlying fund for DSP World Gold Fund. It provides you lowest amount of volatility and one of the best returns. And it typically offers you better beta over gold. This is a historical chart. If you see the yellow line, this is gold prices. This was one of the most structurally strong bull market in gold, and you can see how the BGF World Gold Fund performed. This is a normalized line, so both start at 100. So at one point when gold became 6 times, according to this chart, BGF fund had become 1200, so 12 times. So that was a kind of beta that it enjoyed. And of course, when gold prices drop, these funds drop even more, right? Because they are significantly higher beta versus gold, and that's how they move, right? So now the most important point is if you know that there is going to be a structural bull market in gold, or let's say you assume, according to all the data that we've seen, and there is a good high probability that we could have a structural bull market in gold, what is the best way to play? So if you look at data, there is no doubt that the better way to play gold structural upcycle is through gold mining equities, not through plain vanilla gold exposure or the physical exposure. Now, when you look at the gold mining equity companies, what they do. First is that there has been a huge margin improvement. Over the last few quarters, you see that average gold price has gone up significantly. And if you look at their all sustaining fixed cost, their margins have gone up significantly, right? Now, when you look at their valuations for gold companies, North American gold producers, their price to NAV is close to its bottom of the last 10 years. Similarly, when you look at their EV to EBITDA, again closer to the bottom valuation of the last 10 years. When you look at this chart, this tells you gold miners valuation. They expand whenever the gold enters a structure uptick. So if you look at this teal color line, this is gold miner average price to book for all gold mining companies, right? And when you look at the black line, this is Newmont. I've taken this because this is a market leader, one of the biggest mining companies in the world. So I've taken it as an example here. And the yellow line is the gold price, which is on the right hand scale for gold mining companies. So if you look at gold miners average price to book during the last decade, when gold was in a structural uptick, generally they used to trade at 3.5 times price to book. Newmont mining itself was trading at 2.5 times price to book. Now in this decade, Newmont is trading close to 1.5 times, and on an average, other gold companies are trading at about 225. So there is a huge gap in terms of valuation where they have traded historically when there was a structural uptick in gold. So these lines are probably going to shift upwards. So there are two plays here. First is that if gold prices go up, gold mining companies will see their earnings go up, and it's already visible in number for the last 2 years. Secondly, most of these companies have pared down their debt significantly, very, very similar to what has happened with many steel or copper or other commodity stocks. So their balance sheets look extremely strong. And as I said, their valuations are cheaper than they were in the last cycle. So one, you get an earnings uptick. Second, you also could get a valuation re-rating. So maybe if you don't play for valuation re-rating, there is still a significant earnings uptick possible because gold probably is headed higher. So, and plus you have the comfort of extremely strong balance sheet. So even if there is volatility, these companies will be able to withstand it. If you look at the returns ratio, as I said, they're already at record level. Their ROEs are at significantly high number, generally at cyclical highs. And probably the difference between the earlier cycles and this cycle is that at the beginning of the cycle, where gold prices haven't really moved a lot over the last 1 year, or even if you look at cumulatively in the last 10 years, the companies have extremely strong balance sheets. And I think they are quite ready for the cycle to unfold. And the kind of balance sheets that they now have, this kind of balance sheet generally appears after 4 to 5 years or 6 years of strong gold price movement on the other side. But this time, this kind of balance sheet is available at the beginning. So I think that makes a big difference in terms of how the performance could unfold in the next few years. Also, I think if you look at the dividend yield, it's a lot above where S&P 500 is. So gold producers offer 2.3% in terms of dividend yield. Plus they are doing buybacks, returning capital to shareholders. Again, a very important aspect in this part of the metals market. They've been improving their balance sheets all through. Plus, if you look at if earnings growth comes back, plus valuation re-rating happens, and if you also have buybacks, I think it augurs very well for the stock prices of these mining companies. So this is something to look forward to, which could probably kickstart the next cycle. So why gold mining equities? As I said, gold equities are a better play when you have a gold structural bull market in gold. So gold mining equities are one of the best plays rather than playing any other instrument. And most gold mining companies are better placed than the last cycle. Between 2014 to 2016, many of these companies were on the verge of getting under severe stress because gold prices were not moving up and they had made huge amount of investments. And right now, I think there has been a significantly strong discipline in terms of how they are placed, and that's why their balance sheet has improved a lot. So it's like an athlete which was under a lot of stress has now become extremely fit and extremely strong, and the cycle is just beginning. The season is just beginning. So I think that is the parallel here. Another important point which I have not touched is the INR movement. So DSP World Gold Fund invests in BGF World Gold Fund, and that fund invests in companies which are in companies which mine gold or gold mining companies. But when you see the performance, it is in INR terms, right? So when you convert dollars to INR, if INR weakens, which is generally the case when there is a let's say a disaster or general scenario when gold prices begin to move up, generally we'll see INR is weakening in those times. So INR provides a lot of support to the returns and adds to the returns. So if INR is weakening from let's say 75 to 78, it will get added to the returns. That's how the currency returns move. And secondly, when international gold prices are volatile, INR gives you a comparative cushion. So DSP World Gold Fund becomes even a better play to play to play gold in terms of INR. So that gives you an added advantage. So I think that's it from my side. Just to sum up what I said, gold appears to be in a structural uptrend, which probably is just beginning. Secondly, I think there is a good chance that we'll have at least 2-3 years bare minimum of supportive environment for gold prices. Plus, most other asset classes, as I said, are trading at extremely rich valuation. So if you are looking for a diversifier, I think this is one of the better asset classes available. And once that theory is structurally proven that gold is probably a better place to be in an upcycle, it is best placed through gold mining equities, which I just explained to you why. So I think with this I will end here, and if there are any questions, I'm happy to take. So Usha, if you're online, I'll probably take the questions, or
Yes.
if there are any questions, I'm
Yeah, am I audible, Sahil?
Yes, please.
Yeah, thank you. Thank you, Sahil. There are quite a few questions that have come, so I'll read it out one by one and we'll take it up. The first question is on a topic that's been largely discussed in correlation to real rates being negative and gold, etc. Is, will the unwinding of fiscal stimulus put pressure on dollar, and would that make gold a safer bet? You did cover that in your conversations, but maybe a answer to this question in particular.
I guess what is happening is that when you look at US, the kind of money printing that US has done, the Fed has doubled its balance sheet. For example, I'll give you a number. The fiscal deficit for US this year, US government, is $2.77 trillion this year, one of the highest ever, right? On a GDP of about 22 trillion, that turns out to be about whatever 14-15%. One of the highest fiscal deficit numbers that you could ever imagine, right? And at the same time, the Fed doubled its balance sheet. But the surprising part is that this year the dollar went up rather than going down. And the reason for that is that every other country did the same thing, right? The Eurozone did the same thing. One of the biggest trading partners, China, did something similar at the beginning of the year. Japan did same. India quasi did same, very, very similar stuff. So currencies are not priced in what a country does. They're priced in what competition is doing. So what I foresee is that if globally this easy money supply, which is quite possible that it will go on for some more time, maybe it will reduce in magnitude, but not so much. But if it continues, then there is a good chance that most currencies will remain weak. And second point, historically, whenever there is a crisis, for example, there was global financial crisis, and if you remember correctly, gold actually fell in the crisis, right? It actually started moving up only when things were looking a little normal, and then gold prices just zoomed higher. So that's been the case historically also, that when you are sitting in the crisis, generally gold is either very, very sideways, it generally doesn't move a lot, but as soon as you see first signs of the crisis becoming a little insignificant, gold prices starts to move very, very strongly. I think that could be the case. So two things. One, the dollar has already seen an up move in the last 3 weeks or whatever, 2021. There is a chance that it will probably weaken a bit. Even a small weakness in dollar could magnify gold returns on the upside. And secondly, as I said earlier, most other asset classes are already trading at premium valuation, right? So if they downtick, it will create an incremental investment demand for gold. So these two reasons, I think, are strong enough for gold to perform well.
Sure. Thank you, Sahil. There's a interesting question. Will there be an impact on gold prices due to emergence of cryptocurrencies?
I think it's a question which I get every time. And let me tell you two things. First is that cryptocurrencies have been in existence for more than 10 years now. But they became really mainstream after 2018, right? That is, there was a big rally in Bitcoin in 17-18, and then the whole asset class picked up, and they became extremely, widespread bet more recently during last 1 year. The kind of price move that we've seen, specifically after Bitcoin moved from whatever $3,000-4,000 to $65,000-70,000 in the last 15-16 months, right? That's when cryptocurrencies became a leading talking point globally. And when you look at gold has been in existence in some form or the other as an investment for 3,600 years, right? 3,600 years. And when you look at cryptocurrencies, you could say either it is 3 years or 10 years, looking, whichever way you look at it. So I think right now the scales are not comparable, they are different. Secondly, the use cases are very, very different. So there is when you look at cryptocurrencies, there is a school of thought that they will create a decentralized ledger system in the future and generally become a sort of a currency which can be utilized for as an exchange of value. But right now, I think it is still far. It will take some more time for that hypothesis to be proven, or we get disproven. So we'll see how it pans out. But when you compare it to gold, the sizes are very different. So the overall market cap of all cryptocurrencies put together, last count I saw was closer to 12,000 cryptocurrencies, is about $3 trillion. And the gold market itself is more than $10 trillion. So there is a difference between the size. Both can exist independent of each other. Second is that we are yet to see a financial crisis pan out in cryptocurrencies, which gold has very well seen. I think it has seen many a crisis and proven itself to be a durable asset class. So probably that will clarify what kind of investment flow can go to cryptocurrencies, which should have gone to gold. Right now, I'm not very sure. One thing is very, very clear, that there is a narrative-driven demand which gets created. There is a reflexivity of price. When one asset class is doing well, it generally attracts a lot of traders and investors, and that incremental investment demand or trading demand for the short term does go to cryptocurrencies because of the kind of exceptional price performance we've seen. But is it material enough? I don't have an answer for that, but as of now, it doesn't look extremely important. It may have hit gold negatively at the margins.
Thank you, Sahil. Just a question. This is on gold mining companies, whether it is worth investing, which you had anyway referred quite a few during the presentation. But in continuation to that question, there is also to understand the rupee dollar depreciation, and then how does it impact the gold from an Indian investor's perspective?
So see, India is a gold price taker. We don't set the price for gold. Whatever gold price is set in London or the US, it just gets converted to Indian rupees, and that is the price we pay, right? We don't set our own prices. It's an international market which sets the price. So when the gold price is set in US dollar, for example, if it is set at $2,000, and if rupee is trading at 70 rupees, and let's say in the next 2 months rupee goes to 75 and the dollar price remains at 2000, simply Indian gold prices will go up, right? It will become more expensive. It is just like any other currency. So for example, if dollar weakens, gold becomes more expensive. Similarly, if rupee weakens, gold becomes more expensive, right? In rupee terms. So it's very, very similar, and just replace the word gold with gold mining equities or the World Gold Fund. So if rupee weakens, gold becomes expensive. If rupee weakens, gold mining stocks become expensive. Similarly, DSP World Gold Fund also benefits when the rupee weakens. So that's a clear flow through. There is no other multiplication.
Sorry, I was muted. The next question is on very few new deposits of gold are being discovered. So how does this impact the profitability of the mining companies, which is what the underlying investment for DSP World Gold Fund is all about?
So first thing is that for gold mining companies, what you have to look at is at what price they are selling, right? I'll give you an example. Maybe let me take a very simple example. Let's say, look at Saudi Arabia. Saudi Arabia produces a lot of crude oil, right? We all know that. They produce about 10 million barrels a day, just to take a very simple example, right? So if they sell that oil at $80 per barrel, right? Every day they make $80 million, right? And in 1 year they will, when you look at the whole number, eventually they make 18 to 365, whatever, right? So they will end up making $300 billion or so, right? Every year, 280 or $300 billion every year in terms of the oil that they sell. Now just imagine that if oil price was to fall by 10%, okay, they will lose 10%. So that means 300 billion in earnings will become 270 billion, right? And now let's assume that oil production was to fall by 10%. That means to 9 million barrels a day. That will be easily countered by a small increase in price, because if supply is getting constrained, prices will rise, right? So the key difference or key delta here is on the price. So when you look at gold mining companies, if they are mining less and less gold, I showed you the numbers. the mine supply of gold has been very, very consistent between, let's say, 3,500 million tons a year to 4,000 million tons a year. So 100 or 200 million tons up and down is the delta right now. And I think even, at the pace, there is a projected pace that gold mining companies are producing less and less gold by just about 0.5% a year. So I don't think that kind of a delta will impact us, which when we look at our investment horizon of the next 5 years, right? So that will become insignificant in terms of impacting the gold mining companies. But on the contrary, if it affects the price, which I said moves on the theory of incremental demand, investment demand for gold, which it very well can. 0.5% or 1% of incremental demand can actually stimulate gold prices to quite an extent. So if you look at that case, I think the falling supply from gold miners will become an insignificant point in the investment philosophy or investment theory that we are making.
Thank you, Sahil. Another interesting question. It has come from two people, so I'm combining that. There is this strong case for interest rate reversal, fiscal stimulus reduction, so on and so forth. And that would mean a slight improvement in the negative real rates that you have seen. Right. How does this impact the gold view from a medium to longish term perspective?
Right. So let's say what will make gold prices, take the southward journey. It will take very strong real rates. So for example, if real rates rise above 1%, or 1.5%, it will make gold inferior asset class for the time being, right? So what will cause real rates to go to 1% or 1.5%? They haven't gone to that level, I think, in last 15 years. So when you look at US CPI adjusted 10-year yield, I showed you in the data, it was at 4.7%, minus 4.7%. So what will cause it to go to 1% plus? Either inflation goes to zero, okay, or real rates or nominal interest rates, which is the 10-year benchmark yield, goes to 7%. So I think either of these two scenarios looks less probable right now. Let's say if inflation were to fall back to 2%, which is the normal Fed target, which it probably will in the next 12 to 24 months. It will go back to 1.5-2%, where the US inflation rate has been for a very long time. And at the same time, during that falling inflation level, US has to raise rates enough so that the 10-year yield goes back to 3%, right? And then real rates will become 1% positive. So if all these scenarios don't pan out, whatever real rates are, whether they are minus 50 bips or minus 1%, they will be one of the lowest, or let's say most negative real rates on offer in the last 100 years. Right? So whatever scenario you play out, it generally tells you that at least in the next 2-3 years, it continues to be favorable for gold. So it's not a reversal from an extreme which will cause real rates to become less favorable for gold, but it is the magnitude, and that magnitude is not changing. It may become smaller, big, but it continues to remain favorable for gold.
Thanks, Sahil. There's another interesting question on the demand, which was one of the main factors, jewelry demand being a big contributor to overall thesis on gold. And the question is basically that there is a belief that this generation are less consumers of gold or less inclined to purchase gold, particularly the Indian segment. And would that affect the overall lesser jewelry demand? Would that have an impact on the gold prices?
The first thing is that the question is very right, that it is a general belief. It doesn't show up in data, right? If you look at the amount of gold that we are importing, it's going up like anything every year. And India only consumes jewelry. We don't do anything else. So it doesn't show up in number, first. Second, when you look at the hypothesis that new generation doesn't want to buy gold, it may well be right, but it is still not available in numbers, right? When you look at, let me take another example. Look at companies which sell gold, right? They're listed on the stock exchanges. Look at their performance, look at their volumes, look at their buying patterns. All of them is improving every year, without stopping. So right now, I think it is a hypothesis. It appears to be very true, but there is no data to back it up right now. And let's say even if this trend is true, let's assume that this trend is true. And if it were to pan out like this in the next 10, 15, 20 years, I don't think it will have a material difference on our investment horizon, which is between 3 to 5 years. I think between that horizon, the demand will remain fairly stable. And second, now you have a pent-up demand. Last 1.5 years, wedding season was very, very dull. I think it will probably take 1 year for that pent-up demand to go on, at least in case of gold jewelry and all the traditional requirements which were there. So once that happens, probably it will streamline. So for the next 1.5 years, that delta is still available. And as I said, for our investment horizon, I don't think that makes a material difference to our hypothesis.
Sure. Thanks, Sahil. Is there a view that you would like to share on a multi-currency risk? Somebody's particularly asked about the South African rand, the dollar, and the rupee. Is there anything with the gold as an asset or a choice of investment that could be?
As I said earlier, most currencies have seen financial debasement. Most central banks have printed so much currency that all asset classes, equity, commodities, debt, they have got it re-rated upwards, except gold. And there is a historical precedence to that. If you look at in most crises, I explained that earlier, that gold generally doesn't perform. There are a lot of hypotheses, you can read about it. Alan Greenspan actually, in one of his books, explained why. Because most central banks, when they can't see anything or they are extremely perturbed with what is happening in the economy, they generally go and seek solace in stability of their currency with gold. So they try to maintain all their monetary balances and they try to peg it with gold so that they don't move a lot, because they don't know what will happen during a crisis, right? And that is one of the reasons why gold doesn't perform during the crisis, when you are in thick of the problem. And once you start to see that financial repression is continuing, which is generally what happens after the crisis, central banks are usually slow to recover. That is when gold prices do well. So when you look at currencies around the world, whether it is South African rand, Indian rupee, dollar, euro, JPY, all of them are seeing very, very similar trends. So gold has to get repriced in most of these currencies, and probably it will in the next few years. So from a currency perspective, you look at the chart of gold in euro terms, it's at all-time high. Right? So in many currencies, it is already at all-time high, and it will continue to do that. So I think in most currencies, it will do well.
Sure. Thanks. Any views on the ESG activism and an impact on mining companies?
So from an ESG perspective, I think for gold mining companies, the angle which comes into picture is their own energy cost. If energy costs continue to go up, their raw material prices will go up, and they are very sensitive to it. Right? And that is one of the big risks for gold mining companies. As of now, they've been able to handle it. Some of my discussions internally and our own analysis tells us that if oil were to, as a benchmark for energy costs, if oil was to cross $100, it could cause problems for gold mining companies in terms of raw material costs. Till between 90 to 100, if the oil price remains below that, as a proxy for their raw material cost, gold mining companies can take it with the current balance sheet. So that's the view. It's a risk which we'll have to be cognizant of.
Sure. There is a question in particular to the slide about the gold performance versus the capital market performance, Sahil. Right. So the question is this: gold did not do so well even though other capital markets did poorly. So while there is a strong a negative correlation or a way to identify, why would this happen is the question.
Gold actually did well. I'll show you the slide again.
Sure.
Yeah. I think we are talking about this slide, which so if you look at this slide, so when capital markets went down 2%, gold went up 22%, and when capital markets were doing very well, gold did not do well, and that is where the negative or non-correlated nature of this asset class comes, right? So if you have 100 rupee in portfolio in capital markets and you know that they're going to move together, most equity, I'll give you one data point. The correlation between US S&P 500 and emerging market index is 84% for the last 10 years, right? So they all move together, whether you buy Indian equities, US equity, all of that. So they move together. So if you want to really diversify what you do, you go to bonds, right? So even US large cap stocks and bonds have varying correlation, but in the last few years, last 10 years to be precise, they've got closer to 60%, moving together. Right? So how do you hedge that? You hedge with an asset which is either uncorrelated or negatively correlated, and the only asset which provides you that, at least statistically, is gold. And even for that example, other alternates don't provide you very, very similar kind of returns with the amount of uncorrelation that, or let's say lack of correlation, that gold provides. So I think that's the case. Statistically, it's a strong case. Of course, in real life, on a day-to-day basis or even on a month-to-month basis, it will not be visible. But once we are, let's say, in 2025 or 2030, this data again will get reinforced in terms of how gold performs when other asset classes do not.
One last question that is there is one risk with gold miners, especially outside North America, is the rule of nationalizing gold assets by the governments when there is a meaningful price takeoff in the asset.
Right.
So would this have a impact on the underlying fund that we have?
So largely the fund that we hold invests majorly in many companies which are located in North America, which are strongly regulated, and I think doesn't run the risk of this specific problem. Others are also in Australia, which again is a very, very well regulated market. So I think geographically it is better placed to not get under get under this problem. So I think from that perspective, the active part of the fund, which is the BGF World Gold Fund, manages this risk quite well. In some geographies, this risk may be present, but you can't wish it away. But I don't think it is any significant, or at least I don't think there is any representation of that risk in this portfolio.
Sure. Thanks, Sahil. That brings us to the end of the questions. I don't see any more questions that have got come up, and one or two of them are similar questions that we already answered, like crypto threat and real rates, etc. So that is already answered both in the Q&A and in the presentation. So we'll move on. Thank you very much for joining the call. Sahil ran us through various aspects to consider gold as an asset class, the factors, including why gold mining companies, the beta that it provides, especially during times when the bullish case for the asset is there, how the performance happens, and the kind of under ownership these assets have in the form of gold mining companies, or a different form of assets that we as Indians consume. We take it in the form of either gold ETF, which is a replacement for the jewelry demand that you have, but through a different format of the same asset, but with a different return profile, is what BGF World Gold Mining Fund is, which is the underlying fund for the DSP World Gold Fund. And the case to consider this is fairly strong with a lot of uncertainties. This is again an asset that can always add value to portfolios. It brings, most importantly, the differentiated correlation element, which is always the most important aspect when you create any portfolio. You don't want the age-old saying, all eggs in one basket. All schemes, all large cap, all debt funds, they all reflect the same underlying premise, and gold behaves very, very differently, proven statistically over many decades or centuries. So do consider allocation to the portfolio, and do contact us if you have any more doubts. I did see some questions on fund performance, size of the fund, etc. We will revert to you with those answers as well. So thank you very much for joining the call, and do keep in touch. Thanks, Sahil.
Thank you. Thanks a lot.
Mutual fund investments are subject to market risks. Read all scheme-related documents carefully.